Hi, everyone. Thank you so much for joining us today for stress testing the risk within your portfolio with our Chief Investment Officer, Chris Gauthier. For those of you joining us for the first time, my name is Amanda Sylvia, and I'm the Client Service Associate for Stonehearth Capital Management. I have been with SCM for 3 years, and my primary role includes client service, marketing, and compliance. I'd like to start off with just a few housekeeping items. On your GoToMeeting taskbar, you should see a section titled Questions. Please feel free to submit your questions throughout the course of the webinar. I will ask Chris to answer as many as he can at the end during the questions portion. If we do run low on time and are unable to get to your question, Chris or myself will reach out to you directly to make sure we get your question answered. Now, I would like to introduce our speaker for today. Chris Gauthier is Stonehearth's Chief Investment Officer. He brings more than 15 years of investment management experience to our firm, working with both institutional and individual investors. He's responsible for setting the firm's overall investment policy and strategy, including directing our asset allocation, investment risk research, and portfolio management functions. Chris, thank you so much.
Thank you, Amanda, for that warm introduction. And thank you, everyone, for joining us today in this beautiful, sunny New England weather. Looks like summer has finally arrived here. So today, we're going to shed some light on the challenging concept of risk. We're using the term risk today as it relates to you, the investor, your financial assets, and your financial goals. As you see and hear from the presentation today, risk must be looked at in the context of all three. The most common risk measures used today in the investment world do not. Most view risk in a one-dimensional format. We here at Stonehearth believe that a lot of our industry is doing a disservice to you by not incorporating all three in their approach to measuring financial risk. We here at Stonehearth have come up with a comprehensive solution to this common problem by using a crash test score, which allows us to look at risk in a multi-dimensional format. As a reminder, there is an accompanying white paper that is available on our website and available for download at your convenience. So let's jump right in with what we're going to cover today. So the first thing we're going to cover today is the most commonly used industry definitions and measures of investment risk. We'll talk about why they may not properly capture all the risk that is important to you and the risk that's in your portfolio, a few ways how they're misused, and go through what the commonly used definitions of risk are actually telling us and what they may potentially be leaving out. We're also going to talk about what our definition of investment risk is, the comprehensive plan that we've come up that incorporates the three measures of financial risk. And the most important takeaway today will be your risk score, how we calculate a portfolio crash test score and how it relates to you, the client, achieving your financial goals. So before we kind of go over what our definition of investment risk is, let's kind of define what the world looks at in terms of risk. And when I say world, I'm talking about our investment industry, the common people out there that use common risk measures. I'm going to go through three of them that are most commonly used that we hear other advisors talk about today and break them down a little bit further. So the first one we're going to look at is volatility of portfolio returns. Very simple. What is volatility of portfolio returns? It's dispersion of portfolio returns from its average return. What you most commonly hear advisors and other investment professionals talk about is standard deviation. It's just another word for volatility of portfolio returns. And if we all go back to our math class in high school or college or even primary school, we may remember this formula, which is how we calculate standard deviation. I promise there won't be much math in this presentation. There won't be a test at the end. You don't have to memorize this equation, but I think it'll be helpful to go through it a little bit to see when people quote standard deviation to you or you read about it in a fact sheet or hear about it, you know what it's actually telling you. So what this formula is a standard deviation, and right here, this symbol right here is called sigma. Sigma just equals standard deviation. So if you ever see this symbol in any financial literature, it's referring to standard deviation. This little thing here is a square root. Again, if we remember back to our primary days, nothing earth-shattering here. We all remember the square roots of numbers. This is the difficult part, or what we seem to be difficult, but it's really not that difficult if we break it down to see what it's actually telling us. This U right here is the average. So basically what we're doing here is we're taking a bunch of portfolio, in this case, portfolio returns. So a set of portfolio returns, calculating the average, and then measuring the distance between each observation and the average and squaring it. Why do we square it? Because the formula cannot handle negative numbers. And that should be your first clue that, you know, we may be trying to force fit something here that may not work if we actually have to jiggy rig the formula to make it apply to portfolio returns. So once we get the square root of each of these observations, difference from the mean, we just sum them up. That's it. That's this formula right here, and it's called variance. So it's variance of returns. You take the square root of that to get back to a more normal number, and you have standard deviation. And that's what it is. So I think a simple example here will help kind of clarify what this is actually calculating. So again, we're not going to take a real world example, just a very simple example of a portfolio, two different portfolios with two returns. So the first portfolio, in a simple example, gives you a positive 10 return in year one, so plus 10%. In the second year, it gives you a 20% return. We'd all love to have those returns. So that equals a standard deviation of 10 based on this formula. So you can say it has a volatility of 10. The second portfolio we're going to look at, it has the first return of negative 10, not a positive 10, minus 10% return. And in the second year, it has a plus 20% return, so positive 20. Standard deviation of that portfolio, using the formula here, taking away the negatives, you get 10. The same volatility as portfolio one. And I ask you the question, do both of these portfolios exhibit the same level of risk? I'd be hard pressed to find the answer yes to that question when you have one giving you an absolute return of 30% and another one giving you an absolute of 10%. But by just focusing on the standard deviation or the volatility of returns, that's what can be implied by those two definitely separate but same standard deviation portfolios. So the second piece of the standard deviation that drives me crazy is the ubiquitous bell curve. I'm sure we've all seen this in our, maybe not in everyday life, but most financial publications, and we use it. It's a basic statistical analysis we learned in math class. So what this does, standard deviation relies on the assumption that your data set is normally distributed, which means it's in this bell curve. The main problem that should be readily available to anybody out there is that we have seen throughout history, financial returns do not fit in this curve. We have what we call fat tails. We have negative fat tails. We have positive fat tails. Positive fat tails are good. That's increased performance, really good performance. This is where the majority of your returns lie. And the way to read this is our old friend sigma. So between a -1 sigma and a +1 sigma, all it's saying is that your return 70% of the time right here is going to fall within one standard deviation of your average return plus or minus. That's all it's saying. And we know that the market returns are not normally distributed. Just think about the 2000 tech bubble. That was over here. That was a 4 or 5 standard deviation event. Once in a lifetime. Well, if your lifetime is very short, that may be true, but if you live a normal life, we had 2008 financial crisis follow that. And that was also a 4 or 5 standard deviation event. So way out here on the fat tail. So when we're using standard deviation as a measure of risk, we're fitting it to a normal distribution bell curve that doesn't exist in the real world. So again, those are some of the problems when we use standard deviation. It doesn't mean that it's totally unhelpful, that it has no place in looking at risk. It's just a small piece of the puzzle and should not be looked at as a complete measure of risk. The second piece of risk, second calculation of risk that most advisors use is a probability of negative returns. And this is very simple, up periods versus down periods. So think the percent of positive observations based on a month, quarter, year, any time frame you want to kind of put on that. So the way an advisor would normally phrase this is, I've been up for the past 5 years. So I've had positive returns 80% of the time. Everybody would love that portfolio. You're up 80% of the time. You only have one down year in the past 5 years. The problem with this is it doesn't capture the magnitude. And as we will see, magnitude matters a lot when talking about portfolio performance and basically in the concept of risk. So what we have here is impact of losses. And hopefully for you who have listened to me before, you know that we use this chart a lot here at Stonehearth. Again, because we really want to focus on that left-handed piece of distribution, that tail event, those 2000s, 2008. So you see that if you lose 10% of your portfolio in any given time frame, you need 11% gain to get it back. Quite simple, not that bad. Once you kind of move down here and the magnitude of the losses increase, you can see that if you lose 50% of your portfolio value, you need 100% return just to get back to even, not to gain, just to get back to even. So it's really not a relative risk number for an investor if that one down year that person had was a loss of 50% and the 4 positive years were a gain of 5%. that even though you're a positive return 80% of the time, those 4 positive years of return do not compensate you for that one big drawdown year, that 50% loss. So it's great to say we're up 80% of the time, but that doesn't relate to your portfolio and you achieving your financial goals and having a positive outcome. It just relates to the manager. And you see that's a common problem we see with a lot of these numbers, is that they're measuring more what the manager can do rather than the impact to your portfolio and you achieving your goals. So the last risk measure we're going to look at that's commonly used in the world is relative performance to a benchmark. And this one drives me crazy. Benchmarks have no bearing on you achieving your financial goals or not. They're just a way to measure. And we do use benchmarks here at Stonehearth Capital Management. It's on our quarterly report. We show it when we have meetings reports. It's good to give clients an idea of what's going on in the world, what's performing well, what's not performing well. But in terms of a measure of risk, in terms of how it relates to the client, it's really not the best measure. So basically what you hear a lot from advisors is your portfolio outperformed, insert favorite benchmark here. And you see what a lot of the unsavory players do. We'll change this benchmark. We outperformed the S&P this year. Well, in 2008, that was easy. That's great. And then they may change where we outperformed the bond benchmark in 2009. So they change that up. Also, by outperforming a benchmark, it doesn't really achieve your goals. And what this is just the beta or the tendency of a portfolio's returns to respond to swings in the market. That has no bearing on the amount of risk in your portfolio. It's just related to, again, the manager and the manager's choice of benchmark that they choose. So let's look at a common example to kind of really highlight this point before we move on to Stonehearth's definition of risk. So when we look at relative returns to a benchmark, you see a manager say, look at this relative performance. We outperformed by 10%. This is great. Everybody's happy. Look at that positive 10 performance. And it does look very good, unless the absolute performance of the benchmark was a negative 37%. So yes, you did beat the benchmark by 10%, but you still lost 27% in your portfolio. I'm hard pressed to see how that's a relative performance is a good measure of risk when you're still down 27%, a large negative return here. So again, all these three ways of measuring risk are important to look at, and they are helpful in explaining some portfolio characteristics. But in terms of looking at risk, they're not very helpful from a client perspective in helping them achieve their goals and understanding how much risk they're actually taking in their portfolio. So let's kind of sum up here before we move on about the drawbacks we've seen to the common risk definitions used by a majority of the advisors out there. First one is the backward looking. So all those numbers we looked at, they're all in the past. It's what's happened in the past. And we all know that the past is not a good predictor of future returns. It helps guide us. It gives you some way to judge what's happened, maybe judge their philosophy, but it's very backward looking. It doesn't tell us a lot about what's going on in the future or what could happen in the future. They tend to treat gains and losses equally. And this is a big one when you see the gains and losses, the 4 out of 5 years, and we actually lost 50% in 1 year. We look at the standard deviation and they treat gains and losses the same. That is not how it is in the real world. We all know that losses matter much more than gains when looking at portfolio risk, and that investors are hurt more by big losses than big gains. But yet most of these risk measures treat them the same and don't discern between the difference between a gain and a loss. Second one, fail to account for magnitude. Again, the magnitude of a loss, those big drawdowns, that permanent loss of capital. And the best example I kind of look at this is that we should all be familiar with Warren Buffett, one of the greatest investors out there and has many pearls of wisdom. And one I see quoted, and I should say misquoted a lot out there, is the Warren Buffett's rule, don't lose the money. Rule number 2, see rule number 1, don't lose the money. What people fail to follow on to that is when he was speaking that and when he actually quoted that, he was talking about a permanent loss of capital. He wasn't talking about the everyday normal losses of 1 or 2% in your portfolio, maybe 4% in your portfolio. Those are risks that cannot be diversified away. Those are just going to happen. What he's talking about is those permanent losses of capital, those ones that happened in 2000, ones that happened in 2008, ones that happen during normal years when a client takes too much risk in their portfolio or not enough risk in their portfolio, which it causes them to make uninformed decisions and based on emotion, not on facts. And the last one, and the biggest one, is that most of these, if not all, are more relevant to the investment manager than you. And what we really want to do is focus on you, and that's what SCM does here. You know, at Stonehearth, we have been studying risk since Stonehearth has been in existence. And we have come up with a few and come up with a different one. And we think there's a better than is commonly used today in a risk measure. And it's based on a few different beliefs. The first belief is, and it's really not a belief, we've seen it throughout history, market returns are not always normally distributed. Secondly, risk is not stationary, but fluctuates throughout the market cycle. Think about a stock. If you buy it at 10, does it have the same risk if it's already up 100%? Or does it have the same risk if it's already down 10%, still at 10? It matters. Risk is not stationary, but fluctuates. And in addition to the absolute level of risk in your portfolio, where your risk is coming from, what pieces are driving that risk? Are you exposed to different macro factors? Are you exposed to interest rates rising? Are you exposed to inflation? Are you exposed to equity volatility? Those are equally important as the absolute level of risk in your portfolio. So taking all this into account, and we here at Stonehearth, we do take a holistic approach to risk by viewing it through multiple lenses to achieve a better understanding of the risk-return trade-off. So what do we come up with? When we look at risk and we try to boil it down to that catchy phrase or that Warren Buffett quote, we came up with this: the probability of you not achieving your financial goals. And that's the biggest risk, the most important risk, the risk we need to quantify and measure and talk about whenever we're talking about your investment portfolio. Because again, this is your hard-earned money. You have your own individual goals. It may be to buy a boat. It may be to buy a house. It may be to save for retirement, college education, but they're your financial goals. And the probability of you not achieving them is the biggest risk we have in the investment portfolio. So I'm going to take a look at how Stonehearth shed some light on this risk for investors, which leads to a greater likelihood of achieving your goals. And what we looked at is a portfolio crash test score. This crash test score clearly explains the amount of risk you are taking, where you are taking risk, and the relationship between risk and return in your portfolio. It's third-party software that we subscribe to. It's basically designed by some people coming out of FactSet. Now, we may not be aware of FactSet in our everyday lives, but in the financial industry, they are the leading edge of risk software. And they had some really smart people kind of break off from FactSet and form their own risk software. Again, guided by those principles that we share here at Stonehearth. So what are we looking at here? So we're looking at the S&P 500 index. Hopefully we're all familiar with this. It's the equity benchmark. It's the 500 largest market cap stocks in the US. I use this because most people are familiar with it. If I put up a moderate portfolio, clients may not know what's going on. And it's good to kind of get our bearings and what these numbers mean. So we look over in the middle screen right here, and we have this portfolio crash score, which is a 77. What does that mean? It doesn't make a lot of sense just in isolation. When we look at it compared to the S&P, so the S&P 500 index has a score of 77. What is this measuring? What this measures is the 3 worst outcomes, which is down here, and calculates a score between a 0 and 100. 100 being the most risky, 0 being the less risky. So again, the S&P has a crash rating of about 77. We look at another commonly used benchmark, and we'll use the aggregate. Bond portfolio, which is just bonds, which are much less risky than stocks, a lot less volatility. And we'll see what they come out with as an aggregate crash risk test score. They have a 34. So again, you can see in judging that if you had a total 100% bond portfolio, you're at a 34, and S&P's at a 77. So that can kind of give you an idea of where we are on the risk spectrum when we start looking at our own individual portfolios. So we look at the S&P here, and what are we looking at? What these are what we call stress tests, things that have happened in the past, and we calculate what would happen to this portfolio, in this case the S&P 500 index, if rates rise and inflation. It would be up 52%. And each one gives you a standard definition of how they calculate this. I'm not going to go into the great details. If anybody wants to go into all these details, we're happy to do a go-to meeting, an individual meeting, come into the office, and we'll talk about each individual scenario. But most of them are pretty self-explanatory. If the Fed hikes rates for long term, this portfolio could potentially gain 30% based on history. Now, in addition to the good stuff, the green stuff, we also have to look at the bad. And this is where we really focus on. This is that left hand of the tail, those events that never happen, those 3 sigma 4 sigma events, 2000, 2008, and we can look right here. We have the stock and credit collapse of 2008. So in a likely scenario of that happening again, the S&P would be expected to lose about 40%. Now, a lot of our investors say, you know what, that's just too much risk. 40%, I can't do that, which is why we build diversified portfolios and it's a return between risk and return. So now hopefully we have an idea about what we're looking at here on the crash test. And now we're going to pull up one of our model portfolios. So we're going to look at our conservative model portfolio. This does not represent anybody's individual holdings. It doesn't represent an actual portfolio holding, but a model portfolio that we use here to judge what a normal conservative investor would hold. And we can see it has a crash test rating of 47. Long-term annualized return based on their projections. Again, we got to take that with a grain of salt because we all know about predicting the future, but give you a rough estimate of, you know, how much risk is in the portfolio, what the expected returns are. And we go back to that stock and credit collapse again, 2008. What happens to this portfolio? It could potentially lose 15%. And then we're thinking about that and when talking to an investor, the investor says, you know what? I can't stand to lose 15% given my financial goals. It's just too much risk for me. I really don't like risk. So I say, okay, what if we make sure that we're under 10% in that scenario, that we potentially lose less than 10%. So we move the software over and now potential 2008 stock and credit collapse happens, we'd only lose potentially 8%. We're all happy, but that's only looking at risk from one dimension. We have to look at it multi-dimensions. Now we have to look what had happened to our upside, which is the blue line. So again, we saved on the downside here. We're definitely going to protect ourselves if 2008 happens, but our long-term expected return of rates rise inflation go from 17% to 8%. So again, that's that relationship between risk and return. We can always minimize risk in a portfolio. I mean, if you want to be 100% safe, you can just buy CDs. But again, there's always a trade-off between risk and return. We look at that long-term annualized return, goes from 5% to 3.7. Again, take it with a grain of salt. But if you think about your portfolio goals, one of the goals is to keep up with inflation. Now, by reducing the risk of a 2008-like event, you've succeeded in that, but now you've increased the risk that you may not be able to meet your financial goals. You may not have enough money for retirement. We may not be able to buy that boat that we want to, or that vacation home, or put our kids through college or our grandkids through college. So again, that's what we mean when we take a looking at risk in multi-dimensionals and multifaceted. So we'll go back to our original portfolio, which we have here as conservative. It's at a 47. Again, we also talked about not the absolute level of risk, but where you're taking risk. So 2008 is definitely the worst case scenario here as we see in this portfolio. It's 15%. But is that the most likely path the market's going to take over the next 1, 2, 3, 4, 5 years? We can never predict what's going to happen, but we can put some probabilities on that. And while there is a small probability that we have another 2008-like event, it's very low. And do we want to build a portfolio that minimizes this risk without looking at the other risks that may be, while smaller, more likely to happen? So again, this is why this stress test and using multiple scenarios helps us give a total picture of risk. So we can look at a more likely scenario where we have the Trump trade wars. And again, these are kind of going on now. They're kind of rhetoric. They haven't really been totally filled yet, but if they happened, this portfolio, conservative portfolio, could potentially lose 4%. I always say potentially because, again, there's no absolutes in predicting the future. But given what we currently hold in this portfolio, what has happened in the past and their exposures, more than likely it would lose about 4%. So again, we're trying to focus on that because that's what the more likely scenario would be. So 4% loss, while not great, is not that bad of outcome, especially when we think about what's a more probable scenario, where we see the Fed hikes rates for the long term. Now we're gaining 7% potentially. And even more likely scenario, rates rise with inflation and we're gaining 17%. And all that for a long-term annualized expected return of hopefully around 5%. So again, that's kind of where we go with the trade-offs in a portfolio, looking at the risk in a holistic point of view. What is the absolute risk you're taking in your portfolio, and also where you're taking risk? You know, do you really want to minimize a 3 standard deviation equity drop in your portfolio, which we can definitely eliminate that or get close to, eliminate that risk, but we increase your total risk of you not achieving your goals by reducing this potential return and some of the upside. So again, reduced one risk, but increased another. And that's where I think a lot of advisors miss, where they focus on one risk at a time, either reducing standard deviation or looking at the number of positive returns over a full market cycle, something like that. They don't look at it holistically, and they forget about you achieving your financial goals. So what we're going to do here is also, before we kind of close out this, is look at compared to portfolios at different risk levels and what's the risk return trade-off. So this is great when you're looking at one portfolio and like, this is great, but how do I use this when I'm looking at my own personal situation? So we do have a conservative investor here, what a potential conservative investor would look like. And now what we're going to do is pull up what a typical moderate investor looks like here at Stonehearth Capital. Now again, no actual portfolio, not actual holdings, no one's in portfolio, but just a model portfolio based on where we're seeing risk in the market, that they're up around a 62. Again, which portfolio was better? Is a 47 better than a 62? It depends on your unique financial situation, your financial goals, your financial strength, your investment portfolio. We look down 2008, as you would expect, as we move up the volatility scale, we move up the risk spectrum, increase our equity weighting, we get more exposure to stock and credit collapse in 2008. So in that potential scenario, we definitely could lose more with this moderate portfolio. Flip side, by taking that excess risk, we're also exposing this portfolio to potential upside. So again, that rate rise inflation, looking at that conservative investor, it's only going to go up about 17% probably. This one could potentially go up 37. We look at the long term, this is going up 5, this is going up 6.2. So there is no right absolute level of risk as you look at this portfolio. Is a 47 better than a 62, which is better than 77? It all depends on your financial situation, your risk tolerance, your investment portfolio. And that's how we think is a better way to look at risk in terms of how it affects you achieving your goals. So going back to, we're going to go back to this conservative portfolio here and get a scenario where it has a couple. So we look at this bio and tech momentum bust. So again, what's this saying? They're saying if the biotech and technology stocks crash, they lose some money, this portfolio could lose 6%. What in your portfolio is going to happen? Well, we look at all these red bars and those are the negative performance. But we see some positive here. Total return bond fund, SPIDER. So again, a diversifier, it helps with the risk. We look at this, Fed hikes rates and keeps tightening. And what the difference between this scenario and the scenario up here is, this is a surprise hike, because what matters to markets is what they expect. And this is something unexpected. We have AQ managed futures in your portfolio to kind of help manage that downside risk, kind of protect against those big drawdowns that permanently damage portfolio. And we look at that stock and credit collapse. What's going to happen here? Well, double line is going to help us a lot. And then you look at the AQR, it's going to help us a lot too. It's going to give you that, dampen that downside volatility to prevent those big downside deviations that we want to prevent in your portfolio. Because as we've all seen, the more you lose, the more you have to make up. So a loss of 50%, again, you don't need 50% to gain it back. You need 100%. So again, this is kind of how we use the software. And the one thing I like about this, as you see with that crash test number, you can go as shallow or as deep as you like. You can just use that number, look at it kind of from the surface and figure out what is right for you with your advisor. Or you can compare it to portfolios. You know, advisor 1 and 2 and 3 gives you 3 different portfolios. How do you know what is better for you or what you like more without going into these details? And this is something that this software allows you to do, and what a lot of advisors don't offer their clients or their potential clients to actually go through this exercise. We can actually add in other portfolios. So if you have a portfolio outside of the holdings in here, we can add those in and get a total picture of your risk in your portfolio, of your total financial assets. So again, we just think this is a much better way to kind of look at risk. So kind of closing up here before we kind of go to the questions, you know, to kind of sum up, we have seen how the financial industry's most widely used common definitions of risk are incomplete. They focus more on the manager than the investor. We here at Stonehearth believe that a more holistic approach, using multiple lenses, including the crash test score, is a much better way to capture the true risk embedded in your portfolio and leads to better outcomes. Outcomes, again, i.e. increasing the likelihood of you achieving your financial goals. And with that, I'll turn it back to Amanda if you have any questions.
Thanks, Chris. I just want to remind everybody to use the questions tab there on your taskbar. If you do have any questions, and if time allows, we will get to them. So the first one I have here, Chris, is what is the probability of a client not achieving their goals? What is a good number?
We get that all the time. And again, there really is no one number you can focus on. Again, that's what we talk about, looking at that holistic approach and investment returns, looking at every piece of it. And again, what a number 47 may be right for one client, but a number 67 may be right for another client, which is why it helps to have that conversation, and it's an ongoing, constantly evolving process. And as we see through time, when you're young, in your 30s or 40s starting to save, a number of 70 may be appropriate for you, depending on your financial strength, plus also your risk tolerance, which you work through with your advisor. And as you get, maybe a little bit older, we kind of may move that down. And we also adjust that for the amount of risk we see in the marketplace. So there is no right number for anyone's portfolio. It's what's right for you. And then again, helping you achieve your financial goals and what's the best way and the most likely way to achieve that.
Chris, the next one I have is why do you use benchmarks in your quarterly reports if you don't believe in using relative performance to a benchmark? I think it was the slide under what is risk.
You're right. And I knew someone was going to ask me that. Because I knew that we do use benchmarks in most of our reporting, and they do serve a place. They're just not the whole answer, and we see a lot of advisors using that as the whole answer. Benchmarks are very useful. They kind of help you in explaining how much risk you're taking in your portfolio, given how much risk is out there, how much risk is embedded in the marketplace, and where your advisor is taking it. Helps explain where your exposures and risk is coming from. How can you reduce risk? There's a amount of risk that is available in the marketplace, and judge based on your own individual constraints, your own financial strength. You want to take different levels of risk, but at least it gives you some kind of complete starting point to judge how much risk you're taking in your portfolio and how much you're being compensated for taking on that risk. So we don't think benchmarks are totally useless. I do think they need to be, and a welcome addition to reporting to kind of facilitate the conversation between a client and the advisor as to how much risk you're taking in your portfolio, where you're taking the risk, and why you're taking that amount of risk in the portfolio. So they are useful. They're just not the total answer.
What risk factor is most important in your estimation?
Good question. Again, there's not one rate you need to take. You really need to take a holistic view. So there's not really one rate out there that encompasses everything. We think the crash test score gets you the farthest there compared to any other risk measure, but it's not the complete thing. It's a very good starting point, and it's a way to facilitate the discussion. And again, I think a better way to kind of look at it is, rather than kind of looking at the risk scores, that is the advisor doing what they're saying they're going to do? Do they have a philosophy? Can they explain how and why they're taking risk? And that's what this crash test software allows you to do. It's not only about that absolute level or what's the proper number. It's about, given that number, what's the trade-off between the risk and return an advisor is taking, where you're seeing that trade-off, and why you're taking that trade-off. So we don't think there's any one risk factor that you need to focus on, that it's constantly changing. And again, you need to take a more holistic view and capture the entire picture.
Are you reducing risk given the current environment?
Good question. We're actually not, and you can actually view this on our website. We have it up there. It's updated either quarterly or when we change our risk view. As most of you know, some of you hopefully know, is that we have an internal risk model and also another third party, Ned Davis, that we use. I mean, kind of calculate the amount of risk we're observing in the market. And that's what I really want to kind of emphasize here. It's not a predictor of risk. We're not predicting what's going to happen. We're not predicting what the risk level is going to be in the market 1 month, 3 months from now. What we're really doing is observing how much risk is in the market. And we use a multi-factor, multiple lens approach to do that. If you want to hear more about how we go about that and look at some more factors, I run a quarterly webinar. It's called CIO's Corner, where in addition to talking about the model, we also go into the economic environment, kind of what's going on in performance in the marketplace, and really take a deeper dive into that market risk model. The next one we're running is Friday, July 20th at 11 a.m. And again, you can sign up on our website. It's listed out there. There'll be a presentation and it'll be recorded. So I encourage you, and invite your friends and family, if you want to learn more about what we're seeing and how much risk we're observing in the marketplace, to join us for that webinar.
Chris, that looks like it's it for questions, and you stole the words right out of my mouth about the CIO's quarterly update that you have coming up next month.
Great minds think alike.
Yeah, exactly. So thank you everyone for joining us today. Again, if you have any questions, please feel free to give us a call at 978-624-3000. Chris and myself are happy to talk to you. So we hope you have a great day.
Thank you, everyone.